Florida homeowners are paying $14,000 per year on insurance, nearly triple the national average.
According to a Florida Tax Watch report today, Florida's average annual premium nearly triples the national average, and those rates are even higher here in South Florida.
But here's the thing, it's not just Florida. In California, insurers are pulling out due to wildfires.
A letter from my insurer saying they were not going to renew our policy. They said we lived in a high fire area and they were not renewing it.
In Louisiana and Texas, premiums are doubling due to hurricanes and floods. Even Hawaii saw price hikes after the Maui fires. And no, this is not a small issue. Federal Reserve Chairman Jerome Powell planted the seed, publicly let everyone know that within 10 to 15 years, there will be regions in this country where you will not be able to get a mortgage or property insurance. He claimed banks will not have branches, and of course, insurance companies will be closing down all locations in those areas.
Both banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. So what that is going to mean is that, if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage, there won't be ATMs, there won't, the banks won't have branches and things like that.
And Jamie Dimon, the CEO of JP Morgan Chase, said the window of action to avert the costliest impacts of climate change is closing. In addition, Glenn Kelman, the CEO of Redfin, made very similar claims, saying that you will not be able to get a mortgage in certain parts of the country, insurance companies will be pulling out, and we're going to be walking into a whole different real estate market. Now, when you have the CEO of America's largest bank, the Federal Reserve Chair, Jerome Powell, and the CEO of Redfin all saying the same thing, it's worth paying attention to. And here's the scariest part. Without insurance, you can't get a mortgage, which means it's not just higher bills, it says who can and can't own a home in America. This isn't just a billing problem. It's a crisis that will take away home ownership from millions. So today we're breaking down how the insurance crisis is colliding with real estate and why this could change the housing market forever. So how bad is this really? Nationwide, the average property insurance bill on a single family home is roughly $2,800 per year. That's almost 50% higher than it was 10 years ago, and about 9% higher than it was last year.
The nationwide average is about $3,000 a year for homeowner coverage.
But that's just the average. In Florida, it's a whole different game. Homeowners are paying $6,000 to $7,000 a year on average, and if you're in a coastal region, it's $10,000, $12,000, $15,000, and that's not a big number. It's just becoming the new norm. That number is a massive jump from what it was just 5 or 6 years ago, where in Florida, the average policy in 2019 was $1,988 a year. In California, the wildfires are pushing up insurance premiums between 30 and 40% from just the last year. Texas floods and storms have pushed bills up to about $4,000 a year.
Florida-based homeowners insurer United Property and Casualty Insurance Company has announced it is leaving several states next year, including Louisiana.
And in Hawaii and Maui, insurance premiums up 50% from what they were last year. So what's going on? A perfect storm. More billion-dollar disasters, higher building and replacement costs, and insurers just flat out saying, we're not signing up to lose money. Lumber, shingles, and labor, all more expensive. And every time a hurricane hits or a storm comes through, insurance companies lose billions. Some have pulled out entirely from certain regions, leaving homeowners stranded. Bottom line, in high-risk states, insurance isn't just creeping up, it's exploding. And it's not just homeowners feeling the squeeze. Renters are about to get hit big time because as the landlord's insurance bill goes up, so does the rent. Because just like all businesses, when the costs change for the business owner, the costs change for the consumer. In California, a landlord in San Gabriel County saw his property insurance bill go from $2,600 to $8,600, a 330% increase. And his only option was to raise the rent or lose the property. A Minneapolis Fed survey shows the same trend nationwide. Insurance for multifamily buildings is up 45% in just the last year alone. And 3 out of 4 landlords say that they're going to be increasing the rent in 2025. And here's the big shift. Mom and pop landlords, the ones that are generally most compassionate towards tenants and have that one-on-one relationship with tenants, they're the first ones to fold inside of high cost. And when they sell, they're not selling to another mom and pop. No, they're selling to a corporation or an investment firm chasing high returns. And these firms generally see tenants as a number, not neighbors. And they generally raise rents as soon as they can, squeezing every dollar of profit out of a property. So this insurance crisis doesn't just hit property owners and small landlords. It pushes renters into the hands of Wall Street, where rent hikes come fast and personal relationships disappear. And here's where things get even scarier. Remember in 2020, when many politicians like Maxine Waters came out and they said, landlords, if you need a loan, go to the bank and get a loan. This is when the eviction moratorium was coming out. There was a really big push against landlords. Well, that push has continued to be felt by these small mom and pops. And if you look at the net income of a lot of Wall Street's biggest firms that are in the single family rental market and rental space, their profits exploded during that very time. They had longer occupancies, higher rent growth. It was a great time for these big institutions. And a lot of them got bailouts and a lot of money. So when you look at what's unfolding, very similar situation. The mom and pops are getting stuck and Wall Street is about to celebrate. And here's where things get a little bit scarier. In some states, it's not just that insurance is expensive, it's that you can't get it. Florida has seen more than a dozen insurers go bankrupt or pull out entirely over the last couple years. The state-run Backup Citizens Insurance is now the largest insurer in the entire state with now over 1 million policies. In California, it's the same exact story. After back-to-back wildfire seasons, big firms like State Farm and Allstate stopped writing insurance policies altogether. That's forced hundreds of thousands of property owners into the hands of the FAIR Plan, which is a state-run insurance program. They say this is for last resort. Louisiana, after major hurricanes, over 20 insurance companies have left the market entirely. Their state-run plan raised rates over 60% in 1 year. So imagine this. You have one house, you're paying your mortgage, and then suddenly you get a letter in the mail from your insurance provider saying, sorry, we're out. You scramble for coverage, and the only options you can find are double or triple what you're formerly paying. Or worse, you can't find coverage at all. That's not just stressful, it's a financial dead end. Because without insurance, banks will not give you a mortgage, which means a whole lot of families are getting locked out of home ownership. Now here's the part that really shocks people. Lenders will not approve a home mortgage if you do not have home insurance. When insurers walk away or premiums double, buyers end up getting completely crushed. Deals are literally falling apart at the closing table because buyers simply can't get affordable insurance. And for families that can afford insurance, the payments are brutal. Picture this, your mortgage, it's $1,800 a month. Add taxes, insurance, maybe you're at $2,600 a month. That's like taking on an additional car payment or a second mortgage. Even households making $100,000, $150,000 a year, they're getting priced out of home ownership. When just 5 or 6 years ago, making $100,000 a year was almost a symbol of success. Now, that very person can't buy a home. It flips the script completely. The question isn't just, can I afford this home? It's, can I afford this home next year, 2 years, 5 years from now, if insurance continues to go up? So what happens when 1,000, 5,000, 10,000, 100,000 families cannot afford their property insurance in the years to come? The entire housing market starts to shift. Cash buyers, they end up owning the market. We're already seeing home sales collapse in some markets of the country.
New data shows U.S. home prices are dropping at a historic level.
Home sales fell to the lowest level in 9 months.
In Florida and California, we're already hearing realtors talk about this publicly, that buyers are walking away at the closing table when they hear their insurance quote. And when demand drops, prices follow. One climate research group claims that from now until 2055, we will see a gradual erosion and loss of $1.5 trillion of value throughout the residential real estate market in America. That's not just a market correction. That's entire neighborhoods losing their equity in their homes. And 70% of Americans' wealth is tied up to that very equity. This isn't just about numbers on a Zillow listing. Families are making real choices to move inland, away from coastlines and away from wildfire zones. It's the beginning of what some experts call climate migration. People leaving risky areas not because they want to, but because they have no other choice. Which raises the big question. If middle-class families are moving out, who's moving in? And here's the twist. Even as regular families start getting pushed out, the housing market isn't just sitting empty, someone's buying. Cash buyers, wealthy households, and more institutional investors. In Florida last year, 40% of all home sales were all cash. No bank, no lender, no insurance requirements. If you got a couple million in the bank, you just write the check, self-insure it. Something goes wrong in the house, you fix it with your own money. But for everyone else, they're stuck. And then there's the big funds. Wall Street-backed groups are quietly buying blocks of single-family homes. These are generally homes that the middle-class families can no longer afford. And they could spread out their risk across their entire portfolio, sometimes 10, 50, 100, 200,000 homes. So if there's one wildfire or a flood in one specific region, it doesn't destroy their portfolio, just puts a small dent in it. So while families are told no coverage, no mortgage, corporations are saying, we'll take the risk. And every time that happens, home ownership slips further out of reach for the people who used to define the American middle class. This isn't just about high insurance premiums or canceled policies. It's about who ends up controlling America's housing. Because when small mom and pop landlords can't cover the insurance hikes, they're forced to sell. When families can't afford mortgages and insurance, they're pushed out. And as neighborhoods hollow out and there's less competition, Wall Street firms step in. We've already seen it with rentals. Entire communities being sold to one company. This insurance crisis will escalate that trend. Every time insurance gets too expensive, they're forced to sell. And if there's less buyers, prices go down. If prices go down, the return on capital gets more attractive for those that have it. Wall Street, private equity, hedge funds, wealthy families, entrepreneurs, and successful business owners step in and they take advantage of this moment. We're being told we're stepping into a climate and insurance problem, but it's really a major housing problem. The fewer families that can actually own their home, the more those very communities are shaped by the person that can strike the check to acquire those communities. So where does this all lead? So if the current trends keep going, property insurance premiums could soon rival the very cost of a home mortgage by the end of the decade. Think about it, paying as much for your insurance as you do your mortgage from now until the next 5 years. That means home ownership in coastal and wildfire zones could soon become a luxury. Only the wealthy who can self-insure are okay with the cost. Everyone else will migrate inland and flock towards affordability, seeking what they call climate havens in the Midwest and Northeast. Property values in risky areas are already starting to soften, and researchers predict that this trend will only continue to escalate in the years to come. That's not just an economic story, that's families losing wealth that took a generation to build. Could the government step in? Maybe. There's growing talk of a federal disaster insurance backdrop. But until that happens, the reality is simple. The insurance crisis and the insurance companies are shaping the entire housing market. Who owns where we live and what these homes are worth. So here's the takeaway. Insurance, it's not just another bill. It's becoming the new mortgage. And it's changing the housing market in ways that most people don't see yet. If you've noticed your premiums jumping, or if you know someone that lost coverage altogether, drop it in the comments below. I want to hear what it looks like where you live. One thing most people are not talking about is how insurance companies indirectly control the living standards of millions and millions of Americans as they continue to increase premiums and people get priced out of their homes. They're going to sell these properties to large institutional investors or everyday small business owners that have money, wealthy families. They're going to acquire these properties. Their costs are going to continue to go up in the years to come. They're going to continue to raise rents because they're going to have no choice. And so as they continue to do that, if real household income is not growing with it, something's going to give. That's going to be the living standards of millions of Americans. The next couple of years is going to be extremely important to build wealth and to really focus on learning and putting yourself in a position to grow yourself financially as much as you can and trying to acquire assets with little to no debt, putting yourself in that spot to where you can grow as everyone else is contracting, because I think that's what we're going to start to see. If you are in a really, really great spot now, congratulations. If you're working to get there, congratulations. A lot of people are not. But if you are, over the next couple of years, you'll be able to acquire assets and kind of put yourself in, I would say, a more protected and immune position compared to most other Americans that are not really paying attention to what's happening in insurance, in the economy. Let's have a conversation about this below, and I'll catch you next video.